For our audience, we'll get started in about 30 seconds. We'll just wait for everybody to join. Thank you. Okay, we might make a start. So good morning to our audience, and thank you for attending today's session with Totus Capital. I'm joined by CIO and founder of Totus, Ben McGarry, and portfolio manager on the Totus Capital Fund, Tim Warner as well. Thanks for joining us this morning, guys. Much appreciated.
Thanks for having us, Anthony.
Thanks for having us.
Pleasure. And just by way of background for our audience, I'm myself the CEO of Lucerne Investment Partners, and I also sit on the investment committee for the Lucerne Alternative Investments Fund. Totus Capital has been a position in LAIF, as the market now knows the Alternative Investments Fund has been a position in LAIF from day one and inception. And Totus has been in our investor portfolios also since 2015, and LAIF was first started in December 2017. So been supporters of Totus for quite some time. So I thought what we might start for the audience's benefit is just a quick high overview of Totus. I know many on the call are familiar with Totus, but just for everyone's benefit, I'll get Ben to provide a quick overview of Totus and their overall investment strategy for a couple of minutes. We want to keep today's session quite interactive. So for investors wishing to ask questions as we go, please do so via the chat function at the bottom of your screen, and we'll address those questions. If we do run out of time, we'll make sure that Ben and Tim do follow up post this webinar as well. One thing we'll really focus on today is that, in markets, we know we've had this great run up in equity markets post the pandemic in March last year, but as we're really focusing on, well, where to from here and how to generate returns for investors, and we want to have that as sort of a key focus of today's webinar, where Totus, where Ben and Tim are actually seeing value ahead in the market, but probably more importantly, areas of the market they're looking to avoid. Or potentially actually generate returns on from those positions, being affected for headwinds on a go-forward basis. So we'll focus on that too. But Ben, I might hand it over to yourself again, guys. Thanks for joining us today, and if you could provide a brief overview on what you guys do day to day, that'd be great.
Thank you, Anthony, and thank you everyone for joining us. And please excuse the haircut and the mustache. I'm on a fundraising Movember mission and hit a fundraising target, so I had to cut the hair off. Believe me, it's probably not a permanent look, but so look, for those of you who aren't that familiar with the Totus Alpha strategy, launched back in 2012, coming up to a 10-year track record. We're an absolute return fund. Our point of difference is that we're uncorrelated, or actually have a negative correlation with Australian equities. Over the journey of the 10 years, we've delivered about 15.6% per annum net of fees for clients. And the value add, I suppose, that we have in a portfolio like Lucerne's is that our returns do tend to come at different times to when the overall market is performing well. There is, when we go through this presentation, you'll understand why our return profile is quite different to what the overall stock market does. So hopefully that gives us a chance, if the good environment that we've had recently runs into some chop over the next couple of years, we would have back ourselves to have as good a chance as any, and better than most, to perform in that kind of more volatile environment. And
I think, Ben, for the audience's benefit, you can probably see that on row 4 there of that table, correlation with the ASX 300s now slightly negative. I mean, historically it might have even been marginally positive, but it's always sat around almost zero. And for everyone's benefit, what that means, whether the ASX is up or down a certain period, actually has no bearing on whether Totus will be up and down as well. That's one way to look at it.
Yeah, and just to add to that, that's true for global equity markets as well. So to the MSCI, it's uncorrelated as well.
Yep.
That negative correlation is a little bit skewed by that March quarter last year where the market was down and we were up. Really, I suppose, was an outlier in terms of the volatility, both for us on the upside and the market on the downside. But we did give a chunk of that back in the next quarter. But it means that in a difficult market, you have a chance of a part of your portfolio having a green bar next to it, which is helps with that sleep at night factor. Tim, could we flip to the next one? I mean, our process is quite simple. We're looking for companies we understand in industries with tailwinds. We like established businesses that generate cash, high return on equity businesses, profitable, that have a management with a track record of delivering, and we try to hold them for those kind of businesses for the long term. And then we hedge out our market risk and deliver that uncorrelated return by looking for companies and industries with headwinds, where industries might be highly competitive or it's a very low return or difficult environment at a unit economic level. We like looking for parts of the market where share prices have got ahead of the underlying fundamentals, overhyped parts of the market. And then we look for catalysts for the market to focus in on that sort of share price overvaluation, and we hedge our portfolio. That gives us that buffer when markets sell off.
And it'd be pretty fair to say, given the whole market has basically gone up, that column to the right there at the moment probably has more opportunities than you've probably seen in a long time potentially.
That's right, Anthony. I mean, the meme stock frenzy and the zero interest rate environment where valuation hasn't mattered for an extended period of time is creating opportunities, and we're starting to see some of those more speculative bubbles run into trouble. I mean, we're starting and particularly in highly priced companies with no earnings. We've seen some really big resets in the US in companies like Zillow, Peloton just recently. A lot of companies that did very well at the start of the pandemic as people stayed home and bought products out of boredom or because they couldn't go outside are really struggling. So there's that, and we'll get to it towards the end of the presentation. But in the fads, frauds and failures bucket, we're finding more of those. The market has been allowing a few more of those sort of problematic business models to get into the market cap zone that allows us to short them. So there's probably more of a target opportunity than we've seen for some time in that space as well.
Right.
This is just a chart showing, our average return when the market goes up is, we do that hedging means it's difficult for us to keep up with the market in very strong periods. But our point of difference is on this chart on the right on slide 6 is that our average return, not every month that the market's down, but on average, we've been able to deliver a positive 0.7% return in the average down month for the ASX. And that, I suppose that's why we're in the Lucerne portfolio.
And I think just to that, for the audience's benefit, in terms of how we've looked at our allocation to Totus within the Alternative Investments Fund, it was only sort of 4 to 5 months ago, whilst the market was continuing to rise, we actually increased our allocation to Totus. So again, it's sort of taking that, hopefully that foresight in the market that things are a little bit overheated at the moment, and if there is a correction in the market, of course there's no guarantees, but Totus is far better positioned with their strategy as a long short manager than a traditional long short manager that tends to be more long biased, and that was our thesis there for increasing that weighting, and touch wood, it's turned out to be a good investment call so far because of the start the guys have had to the financial year to date, and we'll get to that shortly.
Thank you. I'll skip through this one, Tim, if that's all right. That's just showing how the book adds value through the longer term. This one also, because I want to focus on, the outlook and the current ideas in the portfolio. But look, this is just a simple overview. We've got one strategy here at Totus. 4 of us in the investment team. Tim and myself are heavily invested in the fund, so a good deal of alignment with clients. And so far, 2020 1 performance. We're nicely ahead of the market, and feel that we're well positioned if that volatility does start to pick up. This slide just shows, I suppose that as at the end of October, we were up about 21% net of fees calendar year to date. The ASX 300's up about 15. We've had a higher than normal exposure, about a 70% net exposure, and the start in November has been relatively solid as well. We're a couple of percent ahead of the market, and the book's holding in relatively well after last night was quite a choppy night. So maybe things get interesting into year end or sometime next year. But as Anthony said, it has been a kind of Goldilocks environment for stock markets over the last 18 months since the pandemic hit. We've had a recovery in earnings out of the pandemic trough. We've had unprecedented stimulus from central banks. We've had also fiscal stimulus from governments. It is difficult to see, that sort of confluence of positive factors, continuing indefinitely. So at some point after every party, there's a cleanup or a hangover, and we are looking ahead to how to position the portfolio for that kind of environment sometime in 2022.
Go through that or not?
Yeah, I mean, this is a good one.
Yeah, this is just a snapshot of the portfolio, and I guess goes back to sort of the investment philosophy and true to label what is actually in the book and how it shows through. So we're running around 40 longs and 40 shorts currently. The short book, this was as of September, but with a bit more chop, the short book's starting to get a few more names in there as we find opportunities. But we have high conviction on our longs, so we have higher weights than our shorts, usually about 3 times on average. And then the short book, they're smaller due to the inherent risk in shorting, and that you have limited downside. So then if we look at return on equity as a financial metric, as a way to assess quality and profitability as a business, true to label, our longs are 3 times the quality of our short book, which over time usually tends to have outperformance versus low returning businesses. And for that, we're paying similar multiples in the market on both sides of the book. So we do hedge out some of that valuation risk of the overall market being high as of current. And then finally, we only invest in profitable businesses predominantly, especially on a cash basis or a unit economic level. And then our short book actually has quite a lot of these faddish, fraudish business models where it's an ever-burning cash furnace where there's no real sight to profitability, which if markets do get wobbly, these are the ones that usually tend to have more downside than stable businesses with strong cash flows.
Guys, I think it's just on that. It's a really important point because everything has just been going up in the last 18 months. I mean, in November last year, where the market was up 10% in a month, that's happened a handful of times, over market history. And I think, maybe it's worthwhile touching on for the audience's benefit is, the amount of liquidity that has been pumped into the system over the last 18 months and the effect it has had on those fads, frauds and failures in terms of like capital markets and how they, these unprofitable businesses with the the right story behind them can just go out there and raise capital, but eventually the music does stop, and what actually happens to these businesses and how that benefits your portfolio when effectively markets rationalise.
Yeah, I mean, look, I saw a stat just recently that 40% of the US dollars in existence were printed over the last 18 months, and that we've got rates still at very, very low levels relative to history. And that has just meant that the runway that investors have been able to give to unprofitable businesses has been much longer than it has been in the past. And there are, I suppose, questionable business models are being given, the benefit of the doubt. But as inflation starts to pick up and markets normalize from that sort of zero rate, massive stimulus liquidity environment, investors are going to start asking questions about, you know, a return. When am I going to generate a return out of this investment? Because my holding costs in terms of the alternative, which is cash or bonds, I can now start to get a return out of cash or bonds. So, you know, I think that is creating, you know, an effect of gravity on some of these more faddish business models. And if inflation does tend to come through, you know, I suppose the guy that's been through cycles of inflation that is well known, you know, most equity managers alive these days haven't been managing money during periods of inflation, but the bloke who has been doing it was Warren Buffett and his partner Charlie Munger. And their observation was that you need to be in, you know, high quality businesses that have some form of pricing power will do better in an inflationary environment. And you know, you can see by that return metric of 29.6% return on equity for our long book that our long book does have that sort of high quality characteristic about it. We're in lots of businesses with very good market structure, whether it's a two-player market in salary packaging and novated leasing in Australia, or a three-player market in global cloud infrastructure. Many of our businesses have, you know, relatively benign competitive environments and the ability to pass through cost increases. And the businesses that you certainly don't want to be into in an inflationary environment or a rising interest rate environment are the businesses that have very low profit margins, or even worse, businesses that are burning cash, because you know, if your costs are higher than your revenues and the price of everything's going up, your costs are going to be rising faster than your revenue line. So your losses will accelerate, and your investors will run out of patience with funding your business. So an inflationary rising interest rate environment should be more difficult for our short book than our long book. So that's one of the key opportunities. We haven't hung our hat out there saying, you know, we think inflation is going to explode. There are some things that are starting to come down. You know, we've seen the iron ore price down, you know, 70% from recent highs. You know, freight rates are starting to normalize. But if inflation does prove to be, you know,
not transitory,
yeah, then I think that could be a very big opportunity for our book of shorts versus our longs.
Do you think inflation's here to stay, guys?
I think it's going to be hard to put it back in the bottle. And, you know, if you run it, you know, you run the economy hot for a period. Yeah, once you've given people pay rises, you know, it's hard to take them back. You know, there's a lot of, you know, just grabbing a coffee in Bondi this morning, there's help wanted signs out there. Yeah, I think there's a fair bit of, it's difficult to get, you know, to get staff in this environment. It's hard. And the supply chain issues that are impacting the global economy, everything that we're hearing is that, you know, they're looking more protracted than people thought. You know, I think people were hoping things like the new car supply issue or the chip shortages would be all resolved by year end, but they're now talking sort of mid 2022 or longer for many of those things. So yeah, it's looking more permanent than transitory for now, but we haven't sort of bet the book one way or the other on that outcome.
Yeah, just to add to that, we haven't taken a macro view and tilted the book, you know, to that inflation's coming. We more think of it from a stock by stock level, in that how would inflation affect our businesses, both from an operational standpoint, but also a valuation standpoint. So, you know, it's definitely something being considered. And then on the short side, it's finding, if it does come through, where are the opportunities where you can tactically add to short positions where you have inflation costs coming through. Things like Ansell at the moment, you know, we've got a short position on, and that's been a COVID beneficiary from increased PP&E in terms of gloves and everything, but they're now getting huge.
By everything, Tim, you meant condoms as well.
Yeah. Less of that. There's been a lot of babies being born during COVID, so maybe not. Maybe that offsets them slightly. But
Ansell's a great example. Like they had their AGM update this morning, and you know, obviously the demand for things like masks and hospital equipment went through the roof with COVID. So they had a very strong revenue growth period last year. That gets difficult to cycle as people, the world gets back to normal, more and more people are vaccinated. We've got, now pills that will mitigate, the severity of COVID. And what they've done is also built, quite large inventory levels because you ramp up production and then demand starts to fall off. You get stuck with inventory, and on top of that, all of your input costs, your plastics, your transport, your labour costs are going up. So, and they've got a new CEO. So that's a good example of a real business that's just did very, very well out of the COVID pandemic. That in a more normalised environment, there's those tailwinds have turned into headwinds. So we're actively looking for opportunities like that to protect our longs, which hopefully will continue to grow in a post-COVID world.
And I think, adding to that macro view, because it's something we've spoken about a lot at an IC level and positioned the portfolio accordingly, that, we don't think inflation is transitory. We think there is going to be quite a lagging effect in the market, but you couple that with the fact that we think central banks will still be quite skittish. They're talking about rate rises, but they're probably not going to be as aggressive or responsible as what they should be. I mean, we saw at the end of 2018 when the Fed tried to raise rates and then, did a backflip literally a couple of months later. And so, yes, rates might start to increase to curb this inflationary pressures, but I don't think it's going to be extreme by central banks, and therefore the problem's going to remain.
Yeah, I think that's right, Anthony. The absolute look, I'm not a macro person, but the absolute levels of debt make it difficult to see rates going up, for extended periods, and the central banks have shown, what they'll do when things get volatile. But it doesn't mean that you're not going to get these, ups and downs along the journey. But if inflation does, really kick off, there's a few, stocks in our portfolio that should stand to benefit quite nicely, and that are still trading below where they were pre-pandemic. And the obvious two high quality ones are Visa and MasterCard. MasterCard had their investor day last night and is talking about low 20% EPS growth out to 2024, I believe. And what MasterCard and Visa do is they're basically a tax on prices. They take a tiny
clip.
Tiny clip on every transaction, and as your cost of goods and services increases, that tiny clip grows commensurately. And they should also benefit as travel starts to come back. The most profitable part of their business is cross-border. When you take your debit card or your credit card to overseas, those interchange fees between the banks when they're cross-border are the highest margin part of Visa and MasterCard's business. So they're both trading below where they were pre-pandemic. The usage of cash has decreased a lot during the pandemic, and then activity levels are coming back. And if inflation kicks off, it could be a very strong revenue environment for those businesses over the next couple of years.
And on top of that, coming back to that whole inflation, on the cost base side, they have a very fixed cost base with high margins, so that a lot of that benefit actually flows through to the bottom line.
Yeah.
You get that double whammy, which is great as an equity investor.
Right.
Okay, we've probably gone through. Actually, this is the stuff that I think is worth focusing on, just the current market situation and observations, and where to from here after this strong run. So I think if I had to sum it up, I'd say cautiously optimistic is our outlook. I mean, corporate balance sheets are in very good shape. Rates are still low versus historic levels. The amount of liquidity in markets is still quite high. So the Fed has said that they are going to taper, but they are tapering quite gradually, going from 80 billion of bond purchases a month down to zero, tapering by 10 billion per month over the next 8 months. Is not exactly hitting the brakes. You're taking your foot off the accelerator, but keeping quite a highly liquid liquidity environment. And we're not seeing any real signs of stress in the debt markets, just yet. Economies are reopening, vaccines and now COVID treatments are improving. and we've got a lot of money on the sidelines. We're seeing big M&A for assets like Sydney airports. There is a mountain of private equity money sitting on the sidelines looking for things. So difficult to go to get extremely sort of bearish on that in the very short term, given that setup. And we're also seasonally heading into a stronger period for markets. The old adage of sell in May, go away, and Santa rallies do,
They do exist. Yeah.
It's amazing how often that market pattern does repeat, and perhaps we're getting the pre-Christmas wobble at the moment, but the environment is still relatively good on an overall basis, and that's why our net exposure is sitting at closer to 70% than the 40% average we have had since inception. But there are risks, as last night there was a 6% inflation print in the US, and that sent the NASDAQ down quite sharply. We do have valuations that are really in uncharted territory versus history. Earnings that as we mentioned earlier, the earnings recovery coming out of COVID has been extremely strong, and the comps start to get more difficult to cycle every 6 months as companies report. And there is a lot of irrational or speculative activity out there in single stocks in the US in particular. There's been all sorts of weird and wonderful companies going for incredible share price ups and downs. And look, I think on balance that creates an environment that's ripe for volatility, and in volatile environments, that's where a long short, the ability to be long and short, does really add something for our clients. A market where volatility is low and trending, it's difficult for a long short strategy to really outperform. But when things get more volatile, that's where we tend to put on a gap versus the market.
And guys, just on that, just for the audience's benefit, many will know, but do you just want to quickly explain what gross and net exposure means for a long short manager, just in the context of that 70% you mentioned, Ben? I think it's important.
Absolutely. So 70% is our net exposure. That is if you had $1 invested with us, the net exposure of that dollar to the market would be 70 cents. But the makeup of that might be $1.50 of long investments in some of those companies that we mentioned, Visa, MasterCard, Objective Corp, and we might have 70 cents, 80 cents of shorts in companies like Ansell or Peloton, which we recently just closed out. But shorts that are companies that are facing challenges or headwinds, or that we think the market has gotten carried away, we might find things more difficult in a rising interest rate environment. So so at the moment, that's not too far off our exposure. I think it's probably more like
it's about 65% net at the moment, and about 200 gross.
Yeah, and for the audience's benefit, obviously, if the market continues to get more expensive and more frothy, that net exposure might come down as you're increasing your shorts but potentially reducing your longs. And then if you ever felt the market was obviously sort of really attractive or dirt cheap again, then that exposure and net exposure tends to go up. But I think in the extreme points, it's worth noting that you guys can actually go net zero or even negative if you really wanted to. Yes,
we have done that in the past, Anthony.
Yep.
And it did provide that that strong boost in the first quarter last year. I think what we've, the lesson that, and what we know that the portfolio does tend to chug along in trending markets like this year. We can outperform in a steadily rising market. We did that in 2015. We did that in 2017. We're doing that in 2021. We tend to do very, very well when markets get volatile and fall quite quickly. It's when markets then rip back that we need to do a better job, and we are very focused on that as a firm of putting in methods of automatic profit taking as markets fall, and in a very structured and formulaic way, getting more exposure to markets as they fall. So yeah, that's right. The net and gross can move over time.
Thanks, guys.
All right. Sorry, Tim, if we go into the next slide. So look,
Just a reminder to the audience, if you did have any questions, just to lodge them in the Q&A section below, and we'll be sure to address them. Sorry, guys, go on.
That's all right. Look, I think some of the big themes that we still think are very interesting that came through. We've just had the US reporting season. I think we're in the last day or two of it now, but we've had most of the large market cap companies report. And one of the observations is that many of the winners that that did very well through COVID are finding the going more difficult this year, whether it's a Zoom Communications or a Peloton or a Zillow Housing. But there are other businesses that did get a boost during COVID that are continuing to go from strength to strength as more and more of the economy has moved into the online world. And the big ones in our portfolio that are continuing to, really fire on all cylinders are Alphabet, the parent company of Google. Microsoft is another one that did very well from the COVID shutdown as people migrated activity online. But what we're seeing with those companies is that activity has stayed online and that the growth has continued to grow off that higher base. So it's been a pull forward of demand to a structurally higher level. And we found some opportunities in companies like HelloFresh, which were big beneficiaries of people being locked in their home, but where some of those habits, like getting meal kits delivered to home 2 or 3 days a week, and saving yourself going to the shops, have become habit forming and have really showed that these businesses can become quite profitable once they hit the scale and the volume starts to go through their network. So we have increased exposure to those structural winners from COVID, like Alphabet, like Microsoft, and been very keenly looking out for high quality businesses that have been sold off by the market because they think that they were just winners from COVID, but we think that they're actually babies being thrown out with the bathwater and are big opportunities for the medium to long term. So HelloFresh is a good example of that, where the share price, the underlying business has continued to go from strength to strength post COVID, but then we've been able to add to the shares on weakness, which is proved to be that the stock's back close to all-time highs now. So we can get into HelloFresh if anybody's interested a little bit further on in the call. Look, Amazon's another one that is a big exposure for us in the US market. We think if you look at all of the FANGs or the teams or whatever you'd like to call them these days, Amazon is the one that has lagged year to date and is I suppose the highest quality or the business that we think is least susceptible to disruption of all of those large mega cap tech stocks. I suppose the key takeaway from their result just in the last week or so was that AWS, the leading sort of infrastructure cloud business globally, the growth has continued to accelerate coming out of COVID and looking forward to, they've built a huge amount of capacity into their network, and we should see margin expansion start to come through for Amazon over the next 12 to 18 months. So that's our largest position in the US at the moment.
We can touch on this one briefly. Another theme in the book of digital transformation, quite similar to bricks to clicks in that we think COVID's had a structural pull forward in a lot of these businesses. As Ben spoke to, Microsoft is the key US holding there. But I guess some of the smaller holdings in Australia that done well in the mid-cap space, Objective Corp, which has been a long-standing position in the book, is obviously re-rated significantly over the last 2 years, especially throughout that COVID period, as that digital work from home and all those things have really increased the need of regulatory and compliance software for governments, big enterprises. So that business keeps going strength to strength, and we continue to own that. And then Dicker Data is a newer position, which is the leading leading IT distributor in Australia and New Zealand to SMB style businesses through resellers. That business has been listed for over 10 years, has an excellent track record of revenue and profit growth, great returns on capital and equity of greater than 30%. And it's an insider-owned business with the founder and his ex-wife owning 30-something% of the business each. And then the management team don't get compensated based off profitability metrics, nothing to do with revenue or sales. So it's very aligned to shareholders, and they buy all their stock on market. So we've used weaknesses in the share price of late around chip shortage fears. The founder sold a small fraction of his stock to finance some personal activities, such as a private jet, which would cause a red flag sometimes, but he has been not in the operational side of the business for nearly 5 years now, and all the management stepped up and bought quite significant chunks off the back of that. So we like that one on a medium-term view. It's done well, and it's one of those reasons why the Totus Capital Fund's quite nice in that it's has a choice to search for ideas all around the market. You know, this was uncovered by sell-side research. No one knew about it, yet it's a $2 billion company. So it's liquid enough, and we can get position, and we've made nearly double our money from our initial purchase so far.
I think that's a good point, Tim, is that, you know, the portfolio, the reason we look not a lot like the market return is that we have a mix of where our returns come from. Some of the world's best businesses, the Microsofts, the Visas, the MasterCards, and the Amazons in the US, which sort of form the long backbone of the portfolio. In the Australian market, our edge is finding undercovered or hidden gems in the mid-cap space. And we've done that consistently over the years with the likes of Smart Group, Objective Corp, which Tim's talked about, and Dicker Data. Dicker Data and Objective have, are very good examples of what we're looking for in our process. They're founder-led businesses. I mean, David Dicker is still the chairman, stepped back from the CEO role, but both of them, the founders and their immediate families, still own over 65 or 60% of stock. I think in Objective Corp, Tony Walls has about 67% of the shares on issue still, and has never sold a share since IPO. Gosh, which is over 15 or 16 years ago now. So, and the reason that they're not that well covered by sell-side research is that these companies tend to be quite cash generative, and they fund their own growth. So Dicker Data and Objective are two examples of mid-cap ideas that have grown and worked beautifully in the portfolio. There are some others in the smaller cap or micro cap and, are acorns, or I suppose seedlings in the portfolio that we hope could grow, along those lines, over the next few years. And there's two in around the 100 million market cap level that we've taken positions in, in recent years that we still quite like. We've talked about Churro, which is a barbecue business, to clients, over the last couple of years. It's just a small cap idea that continues to, has basically paid back about 60% of its market cap since it IPO'd 5 years ago in fully franked dividends, and has also gone from a net debt position to a net cash position. And it's just an under the radar little stock that no sell side research on it, because it generates cash, doesn't have any requirement to raise capital. And, the barbecue business is going from strength to strength in this sort of COVID environment, as people have invested in, staying home and investing in their homes. So we think that that's, still potentially got quite a long way to go, and we're getting paid quite a healthy dividend while we wait. For that.
What's the stock code for that business?
Sure, SHM. So it's trading at about $1.04 a share. It IPO'd at $1 5 or 6 years ago now. Has paid, gosh, it must be coming up on 60 cents of fully franked dividends. And we've used there's been some bumps in the road as they've rolled out this barbecue strategy. You guys might have seen it in your Harvey Norman lift out, or from time to time I'm scrolling through an Instagram feed, or it's probably just coming up more on mine, but they do make these beautiful gas and charcoal fired barbecues that they worked with Heston Blumenthal, and they're selling them all around Europe and into the US. And this post-COVID environment, they used to be a wholesaler selling into distributors in these individual countries around the world. They're now able to access and sell more directly to clients themselves and build that brand. So, Breville's an example of what can happen if an appliances business with a focus on quality can execute, in a big addressable market. And we don't think you're paying very much at all for that barbecue opportunity in Truro. It's only a small position, but it's one that no other funds that we know of own, and it's consistently surprised us positively since we've owned it. The other one that's actually really interesting at the moment, and that we've taken about a 4% position in, it's only an 80 million market cap, is a little software business called Prophecy. The reason that we've
what's the code on that, Ben?
PRO, Prophecy. And look, I suppose it's that pattern recognition or having done well out of software businesses like Objective Corp, like Altium in years gone by. They are the kind of businesses that the market can really get excited about over the medium term. And what you're looking for with software businesses is, in trying to find the next big one, is great products with a sticky, growing, recurring earnings base and a large market opportunity. Now, Prophecy is one that we've been following I've been following for 2 or 3 years with Tim, and Tim's followed it for
4 or 5 years now.
4 or 5 years before I was introduced to it. And we always thought it looked interesting, but in the last 6 months, they've really started to execute and deliver on the promise. And what they do is they create a dashboard for contact centers. So the leading global contact center players, as big organizations run out, need to have multiple touch points for customers. They have call centers, they have contact centers. They're usually rolled out by large players like Genesis or Amazon. Even companies like Twilio have virtual contact centers, and companies implement these contact centers, but it's very complex to work out, to get the most out of running these things efficiently. And Amazon and Genesis, the two major operators of contact centers or sellers of contact centers globally, are recommending Prophecy software, eMites, which is a dashboard for management to be able to track how well their contact center is working. How many calls are dropping out, how many staff they need, how long it takes for a call to get picked up. And at the moment, they've just been reacting to referrals from Amazon and Genesis, and it's creating quite and it's been growing organically at extremely high rates. I think what's the last organic growth rate?
It's up to about it's got a secondary business, but in the eMite business, it's got around 10 to 11 mil of annual recurring revenue now, which was 4 years ago, 2 mil of perpetual licenses. And they've just signed the most recent deal, which was 2 mil per year for 3 years with a big health insurer in the US. So it's starting to get that traction now where they're getting, they've got blue chip customers already, but they're getting bigger and bigger ones at an increasing rate. And so when we were buying the stock, we're buying at a very cheap revenue multiple, but in all software businesses we like to look at, it was break even, expensed all its R&D, didn't need the equity market to finance itself. And so that's when we initiated the position. And then of recent, they've raised 7 mil of capital from existing investors, plus a few new institutions to double down on that sales and marketing, as Ben was speaking about, to accelerate that growth. So we've done well out of it so far, but you think that there's a huge market opportunity there and still very undiscovered.
Yeah, our average price is about 65 cents. I think it's trading at about $1.10 at the moment, but at a market cap of only 80 million. And the customer base that Tim's talking about, the US health insurers Humana, and the other customers they have on their roster are Airbnb, 1-800-Flowers,
Goldman Sachs, Telstra, Carsale, like.
It's very rare to find a micro cap, and this really is a tiny market cap company.
With that sort of client base, yeah.
Exactly, and they don't have to spend a huge amount of money on sales and marketing because they're being referred customers. So the $7 million they just raised that we participated in is to actually go and talk to the installed base of Genesis contact centers and the Amazon contact centers and say, hey, our product, if you add it, will make your life a lot easier to run this. And then they have a small security business called Snare, which is also growing quite nicely, and it's well managed by a former Paralympian, who's so far done everything that he said he was going to do. So yeah, there are. Whilst the market generally does look expensive, you can, if you're willing to go down the market cap chain, still find some interesting opportunities. And we think that those two micro cap opportunities are interesting. The other place that looks quite good value still is shopping centre REITs, which is the likes of Unibail, Centre Group, which owns the Westfields around Australia, and Vicinity, which owns Chadstone, and also a bunch of regional shopping centre REITs. They are actually looking very interesting at 15 to 20% discounts to book, dividend yields of 5%, and there are assets transacting in private markets at book or premiums to book. So as people get vaccinated, come out of lockdown, have money in their pockets, can't travel, activity at these centres is roaring back, and there is demand from long-term capital to own these scarce assets. If you think about an asset like Chadstone or Westfield Bondi Junction, in wealthy first world high income demographics, it's very difficult to replace those assets. And all of the retailers that we talk to, whether they're Australian or global, if you're selling digitally, the physical retailers are developing an online presence, and the digital retailers are developing a physical presence. So that's an omni-channel approach, and you need to have points of presence in these premium centres. So we've got about 10% of the book exposed to these reopening beneficiaries, which are grade A real estate assets that haven't bounced back to anywhere near what they were pre-COVID, and we think that has a good tailwind over the next 12 to 18 months.
Yeah, and so just probably to highlight in that last sort of 10 to 15 minutes, it's it'd be fair to say you just can't buy the market anymore at the moment on a go-forward basis. You think pockets of the market are going to do well, but other pockets are going to come under some stress, and you position the portfolio accordingly. But then in addition to that, where I think historically the fund has been more biased towards that blue chip and mega cap space, not to say you still don't have a lot of positioning towards both those sectors, but now starting to think outside the square a little bit and looking at some of these positions in the mid cap space that the market is unaware of, where you think you can make good returns for investors over time, because at some stage the market will wake up realizing following the index itself is not going to generate sufficient returns anymore, and then start to look at these pockets that you guys are already looking at the moment, and that's when significant amounts of capital start to flow into these stories, and where hopefully you're already positioned.
Yeah, look, Anthony, if you look back in periods where the Aussie market struggled, say 2015, there was a period where resources, the Australian market, the index is dominated by the banks and resources. And when you hit an environment where the going gets more difficult for those two sectors, money really has to flood into the middle part of the market, which is things like healthcare, mid-cap growth stocks, etc. And that was our second best year, was 2015, in that kind of environment. And when we look around, we've got these Chinese developer and issues in the Chinese construction market, which has created a big pullback in iron ore and some wobbles in the resources space. And if you look at our Australian banks, which still make up close to 40% of our ASX at an index level, they're very expensive by historical standards. They're benefiting from increasing house prices, but they've got a lot of cost growth that's coming along with that, and are getting chipped away at very gradually by fintech and neobanks and other competitive pressures. So our banks do look expensive, versus history. They've performed very, very well over the last 12 to 18 months. And in that environment where the banks and resources don't look like they've got a lot of upside short term, that's difficult for the index to really kick on. And if you can tilt your book to reasonably priced stocks that aren't exposed to those themes, like our mid caps or the shopping centre REITs, you've got a really good chance of outperforming the index.
Yep. Well said. I think in the interest of time, we'll probably wrap up in the next couple of minutes, unless you guys had anything else you really wanted to focus on. There's been no questions from the audience, which would indicate you're doing a good job. But if there are any questions to come through, please do lodge them in the next couple of minutes, or alternatively email Lucerne directly, and we'll follow up with Ben and Tim and ensure they're addressed. But sorry guys, you had a couple of other things to say.
Right, look, just on the short side, Anthony, what is encouraging for us is that there are, as you mentioned, already parts of the market that are, are well off 52-week highs and have really started to underperform. And you've got these structurally challenged businesses, the likes of AGL, the AMPs, who are in the sin bin and have stayed there, and just have real changes in their industry that are making it difficult for those share prices to bounce. And in the US, the one that we should have added to this chart is IBM, which is a couple of percent short position, which for us is relatively big, and that is it's basically the opposite of our longs in the cloud infrastructure business in AWS, Azure, and Google Cloud. The places that they're gaining share in that online cloud infrastructure, they're taking it from the on-premise business, which is where IBM's sort of heartland is. So that's a structurally challenged short in our book in the US. And then, as we pointed out at the start of the call, those fads, frauds, and failures, there are more opportunities in that space than we've seen for some time. So a few names that.
So it depends, but a couple of names that we've done well out of. And a lot of these came from COVID and being COVID beneficiaries, which were quite faddish. There was a small hand sanitizer business listed on the ASX, which made about $1 million of revenue a year, and all of a sudden started making $40 million of revenue, and everyone capitalized that 40 mil into eternity.
The stock code start with Z?
Exactly.
Yes, it does. Very questionable management team, cash flows weren't coming through. So the bread and butter red flag started to show. So we've done well out of that short, which we've nearly moved on from now because it's got so small. Some other things, in the e-commerce space, like the Kogans and the Red Bubbles, the question of the sustainability
those earnings,
those earnings, and also the actual business model is somewhat in question for some of them. And then buy now, pay later. We've avoided the afterpays and the market leaders, but the Me Too's or the tier threes, which just continuously.
Well, I think the most of those buy now, pay later companies outside of the top three that have come on market are actually well below IPO price at the moment. There's a number of examples there. You wouldn't think that given the hype in the space, but that's actually what's transpired. Yeah.
You look at the Zips or the Sezzles. They're saying that. It's a product that's becoming increasingly just a feature of the payments space and not really a business model these days. So yeah, there's been good opportunities in that space, and even in the resources space. Every resources boom does create these sort of opportunities where companies get, you know, launched into the stratosphere, and you know, there's a bit of press recently on a company called Vulcan, which is trying to do zero carbon lithium in Germany, and how they're trying to do that is by using geothermal energy to power, you know, a lithium mining operation, and you're sort of putting two complex processes together in an area where it you know, that is not globally renowned for you know, for lithium production, and yeah, there's some red flags there that have been pointed out. So there's things like that are coming up with increasing regularity that can provide, you know, good single stock, you know, opportunities on the short side.
Yeah, I think a really good start is that in the most recent ASX 300 rebalance, 10 out of the 13 that joined were unprofitable, and of them, I think 3 or 4 of them didn't even have revenue. So
It's handy.
You're getting this passive buying in these names, this excitement where business models are completely unproven, and they got greater than $1 billion market caps, which is right in the hitting zone for opportunities. So we're on the lookout for catalysts to get short those things when things start to roll, because they will provide great alpha opportunities.
Great. Thanks, guys. So we just hit the hour mark, so probably we'll wrap things up. But did you have anything you'd like to close on as a brief summary?
No, thank you for the opportunity, Anthony, and to your clients for their trust. You know, we're coming up on our 10 years. There's 4 of us in research. We're highly energized. It hasn't been the most straightforward environment for long short over the last few years. We've had a few things thrown at us, like, you know, central banks doing, you know, unprecedented money printing, people not having to pay, you know, their mortgages or their rent, or, you know, it's been unusual. But I think that's creating some really, you know, interesting opportunities, long and short, and we're pretty excited about the outlook for the next, you know, the next 10 years.
Yeah, great. Yeah, as we are as well, and it's going to be a challenging environment going forward, we feel, and that's why it makes sense to have that underlying flexibility in portfolios, particularly with strategies like Totus. So look, I'd just like to thank the audience for their time today. Hopefully you found the webinar interesting and useful. Again, if you did have any questions or comments, please send them through to our office. And Ben, Tim, thanks for your time, guys, and keep up the good work.
Thank you, Anthony.
Thanks, Anthony.
All right.
Cheers.
All the best. Cheers.